The information discussed in this presentation is current as of the date noted and is for informational purposes only and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
Okay, well, thank you everyone for coming out. Glad the rain didn't stop anybody. If we get lucky, we might get to see a beautiful view of a rainbow. As Ryan had mentioned, I'm Leyah Dauber. I'm an associate advisor with AGUA. Thank you for coming out. So to begin with our presentation, why do we pay taxes? It's a great question that I'm sure we all like to ask. Well, it's a continuous cycle, actually. As we earn money, we want to buy things. We want to get to the point where we're owning items. And at the same time, we're still paying the federal, state, and local taxes. So what falls within each tax bucket? Where is that tax going towards? On the federal level, we have Social Security, Medicare, things I'm sure everybody's familiar with. Also our military, health services, education, unemployment, a couple others as well. At the state level, education again, road maintenance, unemployment. You'll see a couple of these overlapping, such as education, unemployment, and then at our local level, things that you might see on a day-to-day basis, our first responders, our health services, and education again. So how are we paying those taxes? So let's begin with the sales tax. This would be considered as your buy, as we saw on the first screen. This is what you pay when you're purchasing those tangible assets or those services. Depending on the state and the county, this could vary. Currently in Chemung County, it's about 8%. We're paying 4% to the county and 4% at the state level. For federal income tax, we know that this is a progressive system, so as the income increases, the tax rate also increases. A state income tax, this could apply depending on where you live. In some states, there is a progressive tax system. In other states, it's a flat tax system. Others have no tax at all. Then we have our payroll taxes. This is as you earn, as we saw in this beginning slide. This is that Social Security and the Medicare tax that we're paying. Then there's real estate and property tax, which is based on the assessed value of the property that you currently have. It can depend on the state as well as where you live. This would be considered as what you own, like we saw on our first slide. And then we have the estate and gift tax. This applies to the transfer of the wealth at the time of one's passing. We'll get into this a little bit further in a couple more slides. And with that, I'll hand it over to Pete.
We're going to probably throw out a few terms today that we're used to, right? We deal with it every day. So, you know, if we do say something during the presentations and you want to come back to it later for clarification, please do that. I mean, we've got a small group here. Let's be informal. We're here to educate you as much as anything. So please do that. Very simple. Yes, you're not going to leave here a tax expert today. I'm not going to leave here a tax expert either, quite frankly, because this stuff's always changing. It's very complex. Unfortunately, we have access to these codes and this stuff, and sometimes we have to try to go look up some of this stuff. And you sit there and you read it, and you read it again, and you're still as confused as sometimes. It's very complex. That's why people need tax professionals to zero in on those issues that are really, really important to them. All right. So I think one thing to understand about income tax is that there's a lot of purpose to the tax code. It's the government's way of social engineering. They decide what they should be encouraging society to do. So what do they? We get to deduct mortgage interest to encourage home ownership would be one example. There's education to encourage people to help their kids get through college. There's home energy credits and things like that that are out there to encourage us to have more efficient homes. So these things are out there and it's hard to keep track of them all. So what you really need to do is make sure that when you're filing your tax returns, that if you see any buzzwords that you say, well, maybe this would apply to us. There's child tax credits. Does that apply to us? You should then begin to dig into it, because I'm not afraid, I know that people leave a lot of money on the table simply because they're not taking advantage of some of the deductions and the credits that are available to them, right? So be aware of that. The government wants you to pay all the tax that you owe, but not more than you owe, and people do. So please be aware of that. Leyah will take you through some specifics here. There's a lot, we can't cover it all, is kind of the message here. Keep in mind, jot down your specific questions, things that maybe we don't cover, we'll get back to them.
So as Pete mentioned, this is going to be a very broad topic. So to start off with this, these are some broad tax strategies that apply. It's not specific to any certain life stage. If you're just beginning your accumulation phase, or you're pre-retirement, or you just retired, which we'll get into a little bit further, this is just going to be overall general tips. So taking an itemized deduction can be a tax strategy for you. However, it's only if you're above the standard deduction. So standard deduction is what's given out by the government as what you can take to decrease your taxable income. In 2024, the current rates for single filers is of $14,600, and for married filing joint, it's $29,200. So if you find yourself in a situation where you're above this, then you could qualify to take the itemized deduction and lower your taxable income. This does have adjustments based on age, dependence, and a couple of other things as well, so it's always something to consider looking into with a tax advisor. If you open up this booklet, it should be in everybody's folders. It'll have a little bit more information that we're going to refer to, just so not everything is crammed in the slides. I want to give you time to look over it and read it. On page 9, we'll get into some of the itemized deductions, specifically showing examples of medical and dental expenses, what would qualify to put you over that limit. Taxes that are paid, this could be your property taxes, as we discussed before. Your mortgage interest paid, which Pete had hit on a little bit before. This could be for your primary home or your residence. This is something that you have to continue to take as an itemized deduction. It's not just something that you could take with a standard deduction. And finally, charitable contributions that most of us like to give to those organizations. It's something to keep in mind that not all non-for-profits qualify. There is a nice IRS search tool, if anybody's interested, that we could share with you that helps you look up those not-for-profits, but also working with a tax advisor would help let you know if that one does qualify. So then we just have a couple of slides here that will show it more in a graphic view. So we have your real estate taxes, as we mentioned, an itemized deduction, which could be your home, like those property taxes that you're paying at your school, the town, and the county level. You also have your personal property taxes. This could be on your vehicle. If you go and purchase a new vehicle and you have that sales tax, you could take that as part of your itemized deduction. In some states, you're able to take this every year based on what you're paying. But overall, these might overlap a little bit. They could be paid to your state or the city. They benefit the community, and it's calculated on the value of the asset of the home value or the car that you could be purchasing. So then we have this really nice graphic that shows us where the states rank based on the tax level system. So this you guys will have as well, but if you can see closely, it's ranked on a level of 1 as best and 50 as worst. So if we come over to New York State, it's actually ranked at number 47. If we look for the number 1, we have Indiana, and if we look for 50, we have Connecticut. So that's just something to keep in mind, and that's why we go back to how important are tax strategies. How can we reduce that taxable income, because we are one of those states that have a higher tax. So as Pete had mentioned as well, some that you can get as a tax credit that will decrease that taxable income. If you refer to page 11 and 12 again on the booklet, it'll have more information on each of the credits, the amounts, and if you might qualify for them. However, the tax credits do not work like a deduction, like the standard deduction or the itemized deduction that would decrease your income. It's actually a credit that is given to you based on the tax that you owe. So if you have a tax liability, it would reduce it by that dollar for dollar amount. As I said, there's a couple more definitions in the booklets that will give you more examples. But to begin, we have the adoption credit. That could be taken if you're welcoming a new family member, and you'll see the qualifications for that. The child tax credit. This is a tax break for you and your family if you have children younger than 17. Child and dependent care credit. This could cover costs related to child care under 13 or just dependents that you have in your home. Educational credits. There's the American Opportunity Tax Credit as well as the Lifetime Learning Credit. There'll be further details on what qualifies in the book, but the main thing to consider with these is the American Opportunity Tax Credit is used typically for undergrads that are beginning their first few years of college. You can take it then for tuition and expenses. The Lifetime Learning Credit, that is typically used at any time. There's no degree requirements, so you could be continuing your education, your master's, PhD, or furthering your skills in a different trade. The Earned Income Credit, this is based on the income levels and any dependents that you have and your current marital status. And then one that's up and coming that we see a lot of is the Residential Energy Credits. This is used when you're planning to update your home, make it more efficient. One thing that we have as a tip for you, if you are looking to get this credit, keep your receipts because it's really important for your tax advisor to know if that specific door that you installed or window that you had installed qualifies for the tax credit. Each of these will vary each year depending on the availability and the amount that you get. So that's something to also keep up to date.
Well, we'll move in for a moment to capital gains tax. So I'm going to guess that probably most of you in this room at one time or the other have had to pay capital gains tax. And essentially, it's for long-term capital gains, you get a preferential rate. Why? Comes back to I was talking before, the government has purposes for a lot of this. It's frankly to encourage people to invest, help the economy grow. So there's long-term would be any asset that you've held for a year or more, and short-term is under a year. So if it's under a year, short-term, it's going to be taxed at your same rate as your wage or other income that you have. Long-term, we'll get to a slide, will vary based on your other income. So it's pretty easy usually if you buy, for example, a stock. You pay $20 a share today for a stock. You sell it 3 years from now for $33. You got a $13 gain. You pay tax on the $13. It gets a lot more complicated if you have something like a rental property, because it's not just what you paid for in the beginning, but it could be monies that you've put into it to fix it up, right? So that adds to your basis in that property, shrinks your gain, but at the same time, you're depreciating that property, and you got to keep track of that. And as you depreciate it, you get a deduction on your tax return. But now what you're doing is you're reducing the basis because you've already got a tax benefit. So if you have rental properties, it's very important to keep track of all of your expenses that can be applied so that you eventually will reduce your capital gains tax when that property is sold. And we can get into that individually if that applies to any of you. Tax loss harvesting. This is, you can read a lot about this. It's a big thing. The ideal is if you're getting late in the year and you've got capital gains, if you have some other assets, securities or whatever, you might decide to go ahead and sell those so that you can offset some of the gains, because it's you pay tax on the net between all of your gains and all of your losses. So you said, geez, I got $12,000 of gains this year. I'm going to pay a lot of tax. But over here, I got $3,000 of losses. I'm going to take those now. And the thing that you sell, we'll call it ABC company, you sell that. If you wait 31 days, you can buy it back. So you can restore your position. Now, there's risk in doing that, right? In those 31 days, maybe ABC company rises several dollars a share, and you end up, you've saved some tax, but you lost the appreciation on that investment. So when you do tax loss harvesting, it's not like you always do it. It's the opportunity that's out there. It may make sense, but I don't know if any of you follow the Corning Incorporated stock in the last several days, a couple weeks. It's gone up very substantially. Had you done tax loss harvesting a month ago, you just missed the run up. So those are things, be aware of it, but be careful how you use it. Oh, thank you, Ryan. This is what I was talking about before. These are your tax brackets for single filers, married filers, head of households. This tax bracket, so for example, somebody making $50,000 bumps into the 22% tax bracket. This tax bracket determines your capital gains tax rate. So for married couples under $94,000 of taxable income, your capital gains tax rate is 0. Not bad deal, right? You don't have to pay it. So go ahead and not worry about it. If it's the time to sell it, sell it. But guess what? You better be watching these brackets because, oh, you forgot about that $5,000 lottery winning that you had, and all of a sudden you're up into the next bracket, and now you're going to pay capital gains tax. Message here, this tax rate determines that tax rate. Now, clear, I hope. It seems like I had something else I wanted to mention here. Let's see.
I'd just like to add in, this here is what would be considered the tax strategy itself. As you look at the long-term capital gains tax, if you are retiring, maybe your income's a little bit lower after that first year of working, maybe part year, just a couple of months. If we're looking forward to the next year, you might have lower income that puts you in that bracket for 0%. So we might be encouraging to sell off some of those gains if it's more beneficial and you need that withdrawal, and take the 0% tax on it. This right here would be the ultimate strategy to use for the gains in the tax brackets.
We occasionally will have people that have retired and don't necessarily have a pension or a very small pension. They haven't started Social Security. They frankly don't have any income. They need money to live on. It's a great time to sell stuff, have the capital gains, and they won't pay any tax. The other thing I wanted to mention, this will not apply to very many people. As you add capital gains, so let's say you had a huge capital gain, your income's $40,000, and you added $100,000 capital gain on something. You bought NVIDIA 5 years ago or something like that. It doesn't change this. It doesn't impact this tax bracket, but the caveat is it will impact what's called alternative minimum. So it might not impact this, but it could throw you into alternative minimum tax. What is that? The government says you got to calculate your tax 2 different ways. Guess which one you have to pay, the lower calculation or the higher calculation. You want to take a guess at this? So again, you have to have pretty high income before you kick into that, but be aware of that. That's the one caveat. But even those rates aren't bad. Those rates are 26 and 28%. So it's not horrible, but we've seen people make that mistake thinking, I'm not going to owe any tax on the capital gain because this is my tax rate, and then they kick themselves into the AMT. That's usually on something like a rental property or big asset. All right. Thank you, Ryan. Geez, you're quick here, bud. Home is a big thing. So the rule is that if you've had a home and during the past 5 years you've lived in it 2 years, you've owned it for 2 years, that when you sell your primary residence, the place that you declare as your legal residency, that the first 250,000 per taxpayer, 500,000 per couple, you don't pay any capital gains tax on that. So for most of us living in this area, that's all you need. You sell your house, you don't have to worry about it. I'm still baffled by this, but we have a client down in Charleston, South Carolina area, and they built one of these beautiful dream retirement homes, and they've decided it's time in life to downsize. And I believe when they built that home 10 years ago, they might have had $2.5 to $3 million in it. They're selling it. They've got an offer on it, $6.2 million. I said to them, and I was kind of being serious, hey, I'm glad you owe capital gains tax. I'm glad they make that much money, but they're going to be paying capital gains tax because they're way above the $500,000 gain. So again, we'll come back to any of these that you need us to or want to. We'll get into a little bit more of strategy now, which I hope is helpful to you.
So as I had led with, the strategies that we talked about before were a little bit more broad for most tax returns. This, we're going to get into a couple of phases that you might find yourself in and what strategies would work best during that phase. So to begin, we're going to talk about the accumulation phase, pre-retirement. So to begin, this accumulation phase is usually the period of life when you're saving for retirement and you're building up those savings accounts. You're starting early so that you have that significant impact of the compound interest building up until you get to that retirement. So some things that you would want to look at as a tax strategy during this time. Funding Roth IRAs when the tax rate is at the lowest early in your career. So what this means is you might just be starting out with that new job. You're not making the potential that you could be in a couple of years. You want to fund that Roth IRA as much as you can to just pay the tax on it now versus as you get older, you're making a little bit more, you'll want to take the tax deduction on the other side for just a typical IRA. Another method that you could use is funding a 529 plan for any education savings. This is a great tax strategy as the earnings on the funds would grow tax-free. If they're used for any qualified education expenses, that will also be withdrawal tax-free. And in some states, there might also be deductions for you to take as you make those contributions into the 529 plans. Another recommendation would be to review your withholdings being withheld. If you are one that has multiple jobs, maybe working in multiple states, you have a spouse that's earning a little bit more, a little bit less, you want to account for both incomes, this is something that you should review with a tax advisor. They can help you easily determine maybe you had a little bit higher tax liability one year and what the cause was for that. A couple more tips would be to fund retirement plans to the allowable limits when income and the tax rate is higher. So this is what I was talking about a little bit more. Maybe you're now finally a little bit older, you're earning that potential income that you thought that you would earlier in your career, and now you want to take the deduction for the contributions that you made into your retirement plan. During your working years, as you're funding those retirement plans, make sure you take advantage of any employer match that's being offered, because in a way, this could be considered your free money that you're getting into your retirement plan. Also, funding health savings account is a great way to use as a tax strategy. There's 3 really good benefits to this. Your contributions that you put into the account are tax deductible, the earnings are growing tax-free, and if you are making any withdrawals, as long as it's used for a qualified medical expense, that's also tax-free.
Before I move into this, do you mind me asking how old you are? Okay. Do you have a full-time job now? Okay. So it's a great example of starting out. And at your age, if you're going to fund an IRA, a Roth probably makes a lot of sense for somebody your age. Because you're not, unless you're going to start off at a really high income, you're not going to get a lot of tax break for putting money into an IRA. You're not going to save that much. But the Roth, the money that goes in there, will grow tax-free forever. You'll never pay tax on it. So it's great. It's nice to have a young person here that we can use to illustrate that. So this is an area where I spend a lot of my time because my client base is mostly retired. I've been doing this a long time, and A lot of people I work with are my age and older. And to me, it's actually kind of fun because I think sometimes we can make a real difference. I'm going to go back to that example that I used about people that maybe have retired, don't have much of a pension, haven't started Social Security, haven't got to the mandatory ages for their IRA distributions that they have to do. What we'll do is we will look at their tax situation and we can kind of back into some strategies. One is we will take purposely money they may not even need out of their IRAs, pay the tax because they're at a low rate. And what do we do with that money? We can convert it to a Roth and they'll never pay tax on that money again. They're done. Sometimes they just take the money to live on. So the strategy here for me is I want to take some of this pre-tax money that they know eventually is going to get taxed, either to themselves or their beneficiaries when they're gone. And why they're at a low tax rate, convert it to after-tax money. And this is handy because think down the road now a few years, and the couple needs to buy a car. Well, cars are expensive. Well, if you had to take it out of the IRA, they could bump themselves into higher tax brackets. But if they've already converted of it and they have a place now they can go get it, not have to pay tax on it because they paid the tax when they were lower rate, that's a pretty good outcome. So, we talked about appreciated assets already on capital gains. You generally want to hold them a year, but not if it's a bad investment, get out. And here, this comes back to what I was just talking about. You need money. You got buckets, after tax, before tax, Roths that are tax-free. Where do I get it from? Figure out how much income you're going to have for the year, and you can work out really pretty easily where you should take the money from. So to go back to somebody young, if you can build monies that aren't going to have tax on it, it'll be great when you're my age and you're thinking about retirement and stuff, that you'd be able to pull money out of there and not have to pay tax. So having both, creating both when you can do it is a really helpful strategy. And again, we're back to capital gains. If you do downsize your house, you in this area you're unlikely to probably have to worry about capital gains. Okay, Ryan. Oh, this is fun. I've had a lot of these discussions over the years with people about they're going to relocate. And they're leaving New York, so they automatically think they're going to be ahead. Often they are, often they're not. A couple things to keep in mind. New York State, you do not pay income tax on your Social Security. You do for federal, but not at the state level. Each taxpayer has $20,000 of retirement income that's excluded. So for a married couple, the first $40,000 doesn't get taxed. Social Security is not taxed, $40,000 is not taxed. It's not unusual for married couples to pay near zero New York State tax. And everybody just, they hear all the time, we're such, what was the number 47?
Yep.
And we are for during your working years, but not so much in retirement. There's so many other things to consider. Move to some states, I think Virginia would be one example. Every year they tax things like your car, personal property taxes that we don't have. When people move from here to the coastal communities, Carolinas or Georgia or Florida, ask them what their insurance is like. Homeowners insurance on the coast is ridiculous. Auto insurance, it can be almost double what we pay here. Because you think it's because there's a whole bunch of elderly drivers. It's not just that. We have snow, you know, we run in the snowbank. It's not usually bad. They have tornadoes and floods and hurricanes and the cars get destroyed.
Mhm.
So there's other costs than just the tax part of it. This is tax planning, retirement years. I'm going to change that for the moment and say financial for retirement years. Now, the tax advantage of the annual gift limits will come into play for those of you who may be facing a taxable estate. And we're going to get into that a little bit more in detail. That's particularly a bigger deal for New York State than it will be for federal. But you can gift under the 2024 rules $18,000 per person to as many different people as you want per year. Now, I'm not going to do this, but I could give each of you $18,000 and I wouldn't have to worry about estate tax. My wife could give another $18,000. It's $36,000 to one person and not have to worry about it. Something to keep in mind for those of you who might be concerned about that. I think we can move on, right? 529 plans. Very popular. Most people, like myself, put small amounts in for my grandchildren. But some people decide, because they can afford to do it, that they want to do a lot. And so the annual gift exclusion amount for 529 plans, federal government allows you to do 5 years all at once. You can use up 5 years of the annual exclusion. So just be aware of that. I don't have very many people do that, but I have had a few. More common is the qualified distributions from IRAs. So once you have reached age 70 and a half, I don't think that's many of you in this room, so I'm not going to spend a lot of time on it, but let's say you had a required distribution from your IRA and it was going to be $20,000. And you're going to get taxed on that unless you give a portion of it to charity, someplace like the Clemens Center, right, Craig? Then that portion never hits your tax return. 20,000, 5,000 goes to the Clemens Center, you only get taxed on $15,000. Be aware of that. So what we have people do sometimes is, even for small amounts, their church, their favorite charity, whatever, instead of writing a check that they're not getting any benefit for because they're not itemizing their deductions, take it from the IRA. This is a home run if you're over age 70 and a half. You've converted taxable income to basically tax-free income to take care of your charitable contributions. And we'll come back, again, I keep saying this, but any of these things we need to come back to, we certainly will. All right. Leyah, I'll let you take it from here.
Okay. So next we get into tax planning for leaving a legacy. So as we age, what can we do and what tax strategies are there for that time period? First, we would always like to recommend consulting an estate planning attorney that specializes in the area of estate planning, the tax thresholds that they know. We will get into that a little bit more on the next slide. Make sure you're avoiding any surprises is what they can help you do by knowing the tax laws and helping you plan effectively for that estate. Make sure that you're allowing your benefactors to take advantage of the step-up cost and basis for highly appreciated assets. So what this essentially means is, at the time of one's passing and you're planning to give part of your assets to your beneficiaries, they actually receive the assets at fair market value. So it's stepped up from what you had purchased it at and given to them at what the current fair market value is. This could be either an increase or a decrease. As they receive this, if they were to turn around and sell it the next day, which would be a short-term sale, they would have no gain on that because they had just got it the day before, unless it significantly increased overnight. They'd only pay the difference on what that was. So the step up is a great tool because they aren't paying an excess tax of which they would have at the time it was purchased. So that's something to keep in the back of our minds. As I had mentioned, there is an estate tax threshold. So currently for 2024, the threshold is 13.61 million per individual. So if the estate is less than the 13.61, you qualify for the exemption. It's also 27.22 million for a married couple. One thing to mention on this is that there is the potential for this exemption to revert back to previous levels before the Tax Cut and Jobs Act was initiated in 2017. So this could be as the sunset of the exemption, if you've heard that. There is a potential of this to decrease from the 13.61 million down to approximately 6 million. Not a sure number on that yet. It hasn't came out that this is happening in 2025. It's still kind of up in the air, but it is something that we want you to be aware of.
Okay. So the exemption amounts deal with both gifts you make during your life, gifts, and estate tax, and at the levels that Leyah has spoken about. Both are based on the market value at the time of the transfer. And I think that's all I really want to say on that. We'll move on. Here's what happens. You go over the exemption amount. So let's say somebody has passed away and they're over the exemption amount by $100,000. So it's 13 million and something, and they're just 100,000 over. Look how quickly the estate tax rates come up. They're at 30% by just being over by $100,000. And it gets up to 40%. So the estate tax rates, once you're over the exemption, are pretty significant. So those people that are facing big estates, what they end up doing, they don't want to have 40% of this go to the government. Those are the people who start doing the gifts to their family members, so forth. And there's a lot of strategies around that we can talk a little bit more about later if you want. So federal has a very large exemption amount, right? This is what I've been looking forward to talking to you about. This is, to me, just fascinating. New York State is not as generous. So for 2024, it's 6,940,000 is exempted. What'll happen is the state says, okay, you pay nothing under that level. If it's between that and 5%, 105% of that number, 5% more, or 7,287,000, they're going to tax you on the difference between this and that. It gets really ugly after that, because once you get past 105%, they're going to tax your entire estate. You're not going to get any exemption. So it can actually turn out that people owe more estate tax to New York sometimes than the difference of going past 105%, more than 100% tax rate. So go to the next one. But I wanted to show this to you. I did the math here. 6,940,000 or less, no tax. This person had stayed within the range, the 105%. They owed $12,240. That's not bad on a $6 million estate. You know, I don't think anybody's going to be too upset with that. But this poor person, they went past the 105%. 7,280,000, 7,290,000, $10,000 more. They went from $12,000 in tax to $676,000 in change. That's called going over the cliff. It's a big deal in New York State. I've once had somebody get caught by it. What happened, they tried to give away money and they tried to do everything, but it was an elderly man and he had forgotten about a private investment he had made that was worth about $120,000. Nobody knew about it. We had balance sheets, we had records, but in the proceedings of the estate, this came to light. Nothing you can do about it except pay the tax.
So as we get towards the end of our presentation, we'd like to leave you with a couple of things. First one being tax avoidance is legal. You're using the tax code to your advantage. So everything that we talked about today are strategies that you could use to help mitigate those taxes. There's no obligation to pay more tax than the tax code requires.
I don't think people, tax evasion is a strong word, but often we will have people that push the limits, I guess is the way to say it. One that comes to mind, this guy's not really doing this anymore because he's retired. But I worked with a man who was a psychologist, but he really worked in doing consulting work for corporations and stuff. He was single. He was always going out to dinner with somebody who had a business tie. These were actually some military people, they were corporate people, and he was trying to write off all of these expenses. His argument was, and it was a fair argument, I'm networking. I'm taking these people out to dinner to talk to them about business stuff so they can give me referrals and I can produce more taxable income. Maybe, maybe not. I used to challenge the heck out of them to make sure that's what this was really about. So it's not just tax evasion. My advice to you is don't push that envelope too hard. It's not worth the aggravation. It's not worth fighting the battles. My wife is a real estate agent. She gets mad at me. No, you can't take that. You can't take that. I'm not going to let you do it. I don't. You know, I'm preparing your tax return. I'm not fighting the battle. So just use some common sense. You know, none of us want to pay taxes, but once they've got you and they start looking into things, you might not like the eventual outcome. So please just use some common sense there. And this all comes back to what we said in the beginning, really, is when we were talking about the exemptions and all of that. Don't study the tax code. You got better things to do, but be aware of the key things that might apply to each of you. If you own a home, if you've got kids or whatever that are going to college, be aware that they're out there. Don't be an expert at it. If they're out there, then go get the help you need.